Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coughlin. Hope you can see my screen and hear my voice okay. Just let me know if you're struggling, and otherwise I'm assuming I'm coming through loud and clear. Don't forget, as we look at different entries, extracts, different economic events coming up, we will be looking today at the Federal Reserve meeting taking place later on in the session, as well as the Bank of England interest rate meeting tomorrow. We'll be getting ourselves ready for that, looking for the opportunities that we currently see in the markets. Don't forget that you can ask questions as we go along, and we can cover things as we move around. Don't forget that it's not trading advice. This whole idea of these webinars is you're looking over my shoulder, someone with a professional trading background, and you see how I go about making trade decisions. I'll try and make it interesting today and show a few potential tradable opportunities that are in the market over the medium term, so it keeps it Yeah, okay, great. Thank you very much, Mohammed. That's great. Lovely. Thank you. That's why I check. Mohammed, thank you very much. Screen should be okay. Yeah, that's great. Lovely. Okay, so this is what we're looking at, the Federal Reserve and the Bank of England interest rate meeting. So without further ado, let's go over to my other screens and we can look at what's going on. Now, let's first of all just understand what's going on in markets. And I'm going to do it slightly differently today. We're going to be looking at, got a basket of currencies here: dollar, euro, pound, Aussie, Swiss franc, yen, CAD, New Zealand dollar. I'm just going to run through what's going on. So first, if we look at the euro and the pound, both of these have been sold off over the last few weeks on the geopolitical risk. Because of the proximity of Russia to Europe and the United Kingdom, the worries about a spillover in economic impact has resulted in the pound and the euro both selling off quite sharply. So that's the issue that's going on here with the pound and the euro. Now, the dollar has been rising significantly over the last few weeks in expectations of the Federal Reserve hiking interest rates. Now, tonight, the Fed is expected to hike interest rates by 25 basis points. Now, typically, there's some research by JP Morgan which says that once the Fed starts hiking, then typically we see the US dollar weakening. So this could be a top for the US dollar, depending on what happens with the Federal Reserve. So that's why the US dollar could start to be looking a bit toppy now. The Aussie and the New Zealand dollar have both been gaining recently because they are a long way away from Kiev. And the gains we've been seeing in the New Zealand dollar and the Australian dollar have been on the boost high we've seen in commodities with iron ore, copper, coal futures, all soaring high. All of that's been supporting the Aussie, and New Zealand dollar has been supported with a very hawkish monetary policy outlook from the RBNZ. Their terminal rate is expected to be 3.3%. The yen has been extremely weak recently, and the reason for the yen weakness is there's a number of reasons. So first of all, high oil prices results in weak yen. You can see here, if you look at this US oil chart. Now I'm just going to turn the oil to red, and you can see, look, typically when oil prices rise, that weakens the yen. So rising oil prices equals weaker yen. You know, falling oil prices, stronger yen. You know, rising oil, falling yen. So the yen has just been so weak with oil prices surging on the commodity concerns regarding the Russian geopolitical crisis. Swiss franc, again, has been pretty even with bids coming in for risk off blows, just fairly supporting the Swiss franc over the medium term. So that's a quick look at currencies at the moment. Now, the majors are just starting to close up ahead of the FOMC meeting later on. So this is what you'd expect. Market's just been quite cagey, waiting to see what happens. We will cover how to trade the FOMC meeting later. Now, stocks have been boosted today on a number of different reasons. First of all, the latest out of Russia is that they say they want to demilitarize Ukraine like the Austria-Sweden model. And this is increasingly being seen as a compromise, that Russia's willing to compromise. Ukraine has said that only a Ukrainian model with security guarantees will work, and that's just helped lift sentiment. But that could all change with the Fed meeting later, so we'll cover that. The other positive bit of news that's lifted sentiment for stocks today is in the China A50. You can see the China A50 has gained 10% today. Now, that has been on the news that China's State Council has vowed to keep the stocks stable. So the China State Council has vowed to keep stock markets stable, and there is the situation that the People's Bank of China could be cutting rates. So all of this has allowed China's 50 index to gain. Now, over the medium term, Chinese stocks offer really good value. Okay, so first of all, if you just look here, you can see that markets just finding support now at that level. So this means stocks can be placed quite safely underneath that 12,000 region. So when it dips low, you expect to find buyers. Stocks can be placed under 12,000. And if you look at the falls in China's 50 index, you can see last year, the stock fell 30%. So that was a 30% drop. And you can see in 2015, when China's 50 index, you can see there had a 45% drop, then it recovered. And then you can see in 2018, had a 32% drop, then recovered. 2020, the 50 index had a 22% drop and then recovered. So now we can see that China's 50 index has had, look, a 40% drop from those recent highs. So this looks like the kind of region that price will be grinding higher from here. Okay, this does look reasonable. So China's 50 index, the government is supporting the outlook. Not only the government, but also the People's Bank of China could also be cutting interest rates. All of that supported for Chinese stocks. So that is a significant development that took place overnight, okay, and is one to be looking at as we move through the markets, okay, as we go through later. That looks very good. So if the Fed are more dovish tonight, we'd expect more upside in the A50. And over the medium term, that does look attractive. Volatility, see nicely just pushing lower beneath that 30 region. That's very nice. And as volatility pushes lower below that 30 region, then that's supported the stocks as well. Volatility below 30, because they typically, when volatility is elevated, if you just notice here, just say we take a, let's take a quick look at the S&P 500. We'll just put it up here. Let's just see. What you can see is rising volatility, falling stocks, rising volatility, falling stocks, rising volatility, falling stocks, rising volatility, falling stocks. Now, if volatility starts to trend lower, right, we can expect stocks to start trending higher. So this could be a short-term bottom in stocks. Now, what's going to determine this is what happens with the federal interest rate decision. Now, I'm going to go and look at a report done by Financial Source, and they've really done an excellent job. And I work as one of the analysts with Financial Source, and this is what to expect, okay, from the FOMC. Okay, now an interest rate hike is priced in, 100% chance, but there's a 13% chance of a 50 basis points move. So if the Fed hiked by 50 basis points, you can expect immediate downside in the euro-US dollar pair. So one way to potentially handle that is just very simply have a sell on stop 30 points below the price. Is one way that traders sometimes would handle that. And if there's a 50 basis points rate hike, there'll be like a 70, 80 point move. Now, if you've never tried that before, this is not the time to try it. You want to try it on a demo account, or see how your broker responds to these kinds of moves. But just selling on stop with 30 basis points below price, and then if there was a surprise rate hike of 50 basis points, you would expect sudden downside in the euro-US dollar typically. But in this scenario, because the communication is so key, it wouldn't be one to hold, it would be one to close almost immediately after the surprise decision. So if there's a surprise move of 50 basis points, expect immediate euro-US dollar downside. Dot plot. Now the dot plot is expected to show 5 or 6 rate hikes this year, up from the 3 in December. So 3 in 2023 and 2 in 2024. That's what's expected. Terminal rates expected to move up to 2.5 to 2.75%, up from the neutral of 2.5%. Inflation expected to move up to 3.5% for 2022 and 2.5% for 2023. Quantitative tightening, that's the end of quantitative easing. No announcement or clarity expected at the meeting today, with some expecting the bank to signal an announcement possible at the next meeting. So that means the bar is set very high for the Fed to have a materially hawkish surprise today. You can see that STIR markets, short-term interest rate derivative markets, are actually pricing in 7 interest rate hikes this year. That's awfully high. So for markets to be surprised, it needs to be more hawkish than that. So this is what we look for. And also notice that typically, before tightening, the dollar strengthens, after tightening, the dollar weakens. So generally speaking, the kind of dollar peaks just into the tightening by the Fed. So we're expecting the Fed, potentially to start seeing weakness out of this meeting, potentially. So look out for that. Now, the hawkish reaction would be a 50 basis point rate hike, 6 or 7 dot plot projections for interest rate hikes, terminal rate to be seen as 3%, quantitative tightening, maybe like an early announcement of a May start, inflation projections close to 4%. That would be the hawkish scenario. The dovish scenario would be if the Fed take a 25 basis points rate hike, but they don't give any strong guidance towards 50 basis points. You get a sell the fat response. Dot plot, it may be like 5 would be disappointing. Terminal rate staying lower, 2.5% would be a bit conservative, and maybe QT is pushed out timeline. Inflation projections below 3.2% for this year, and to 2023 unchanged. Now that would be a great potential for gold. So if the Fed are dovish in this scenario, then look at gold upside and S&P 500 upside. Also potentially look at euro-US dollar upside. So this would be the potential opportunity here in gold markets. So just take a look here. Gold is sitting around some very interesting levels. And you can just see this attempt here at maybe just trying to hack out some kind of potential bottom around this 1910 region. Now, if it's more dovish, then you could use this level to lean against, looking for a play back up to 2000. Now, what's happening with gold markets? Let me just explain this to you so you understand. Now, gold is potentially a very good point. Now, when you look trading gold, okay, the best scenario, you see here, we've got the red line, which is the dollar, and the real yields. When you've got the dollar and real yields dropping, that tends to make gold surge higher. So dropping real yields, dropping dollar, soaring gold. You see here as well, dropping dollar, dropping real yields, right, soaring gold. So recently, what we've been having is dropping real yields but rising dollar. Gold's still been soaring, but the fact that dollar stayed strong has just meant that gold hasn't had like, you know, a one-way move. It's been up and it's been down. If the Fed are dovish tonight, you'd expect real yields to drop lower because 10-year yields would fall. Inflation expectations remain the same, so real yields would drop. And you'd also expect the dollar to drop. That would be a great scenario for gold upside. So if we get a dovish Fed, then we could get this scenario. We've got falling real yields, falling dollar. It's just gold all the way. Falling dollar, falling real yields, gold. Falling dollar, falling real yields, gold. Falling dollar, falling real yields, gold. At the moment, we've got real yields rising, dollar rising, which is gold downside. But if that policy changes as of tonight, then gold looks ready to retest those sort of 2040, those 2040, 1950 highs going back to 2020. Right? So keep your eye on that, and similar outlook for silver. Silver should respond exactly the same as gold in that environment. Now tomorrow we have the Bank of England meeting. Now the Bank of England is in a tricky position because the Bank of England has seen higher wages this week. Now if I just go and have a quick look at the Forex Factory, I'll just quickly pull up this week's economic data, and you see yesterday the UK average earnings came as high 4.8%. Now that puts pressure on the Bank of England because high wages are indication that inflation is starting to get into wages. So the Bank of England tomorrow is expected to hike interest rates by 25 basis points. Now, the pound has been tracking higher since that strong inflation print, strong wages print yesterday. So we see it move high. Now, what we're looking for here, if the Fed are very dovish tonight, then we could get a pound US dollar upside. So look out for that heading into the Bank of England meeting tomorrow. Now, at the last interest rate decision, the Bank of England kind of signaled a surprise interest rate hike, and some wanted 50 basis points, but then they gave quite a dovish landing in the sense that they said the outlook for growth was quite poor and was, you know, dropping a little. So there were some mixed messages coming out of the UK. But if the UK hiked by 50 basis points tomorrow, then you could expect a significant spike higher in the pound US dollar, and the way to express that would be euro pound short. But if we get a dovish Fed tonight, but a more hawkish Bank of England tomorrow, then we could expect some upside in the pound, and the trigger to go long would be if there's a Russian-Ukraine peace deal. So if we get a dovish Fed tonight, you'd expect the pound to move back up to 1.32, just underneath 1.32. If we get a more dovish Bank of England tomorrow, then we'd expect more. If we get a more hawkish Bank of England tomorrow, maybe a 50 basis point rate hike, expect more upside. But then the catalyst for definite upside would be if we got the end of the Russian-Ukraine crisis. Then we could look for a retest up to 1.3500. So pound is worth looking at and keeping a tight look on. But we've got to remember with cable that risk that we've also got with the Federal Reserve meeting tonight. So Fed meeting tonight is going to be the really important one. Now, in terms of other medium-term opportunities, there are some good opportunities, and there's a particularly good opportunity in the New Zealand dollar Japanese yen pair. I'm just going to run through that with you. Now, the New Zealand dollar Japanese yen pair has been tracking higher for good reasons. And the good reasons are that the RBNZ is the most hawkish central bank. They've got a terminal rate of 3.3% now. They have got a very low unemployment, inflation is high, and they're expected to hike interest rates continually now over the next few meetings. That means New Zealand dollar upside makes sense. The Japanese yen has significant reasons for weakness. One, high oil prices weaken yen. Two, inflation is comparatively low in Japan, with the headline at only 0.5%. And when you consider that inflation is really high in the US, nearly as high as 8%, you can see how there's no pressure on the Bank of Japan to hike interest rates. Thirdly, the Bank of Japan has said that they're going to make sure that bond yields remain bid in the plus 0.25 and minus 0.25 band. So let me just show you where that is. So take a look here at the Japanese. Oh, here we go. Take a look here at the Japanese bonds. Now, what the Bank of Japan have said is they're going to buy bonds unlimited amount if price goes up to that 0.25% region. See, Japan don't want their yield going high. Now, Japan has a big export economy, very happy to see a weak yen because it means their exports are cheap, their exports are competitive. You know, you think of Toyota, think of Nissan, you think of some of the big Japanese manufacturers, their sales are boosted and their bottom line profitability are boosted by a weak yen. So they're happy to see that. So that's another reason why the yen should remain structurally weak. But there is one problem with this, and that is, and there was some news out today with the Japanese PM saying that he's sort of, got an eye on the high energy prices and commodity prices, because they've been making it a little bit harder for some small importers in Japan as well as households. Japan's a net energy importer, so that means high energy prices, high commodity prices can be a difficulty for certain segments within Japanese society. So it's always a bit of a balancing act. Generally speaking, Japan are happy to have a weak yen, but just keep your eye on Bank of Japan monetary policy. There is a meeting this week, and no changes expected, but it is a risk to this outlook. Otherwise, you can look at going long from like 80.20 and looking for a move back up to 81.90. Stops just underneath 79.40, and you could even look for a long from market. Stops underneath 79.40, looking for a move back up to 81.90, 81.80 region in the New Zealand dollar yen. Get a bullish close with no wick on this candle. Typically, from a price action perspective, that would be a very good indicator of higher prices. And if we had a close similar to the way the candle is now, if there's like no wick, do you see there's no wick to that candle? If we get a bullish close with no wick after the FOMC tomorrow, that is just a clear signal to go long, looking for a move back up to that 81.50, 82 region. Okay, folks, I do hope that is a good, rundown. I think that's a good indication of what's coming up. We've looked at the Fed, we've looked at the BOE meeting, we've also looked at the opportunities that there are in the New Zealand dollar yen. We've also looked at the A50 and the opportunities that are there. Plenty of opportunities. Always make sure you manage risk, never over leverage, always know where you're going to get in, get out. Remember, and this is a great chart, there is one weakness with trading macro FX, is that there was a good case to go long New Zealand dollar yen when price was up here around the 81.90 region. We had a RBNZ meeting, and it may have surprised you, but the RBNZ meeting around early November became the most hawkish central bank out of the G8 currencies. The bond yield spread between the New Zealand 10-year and the Japanese 10-year was also very high. Let me just show you that. Right, you see that bond yield spread? Do you see? The bond yield spread was pushing higher. Everything would be indicative for further prices. Now, this is why when you enter, you must always enter and know where you're going to get out. Because if you'd entered here at 81.80, right, you might think, well, yeah, I'm bullish. And where do you put your stop? From a macro perspective, you've got to have your stop underneath 74, right? That's the obvious place. But would you really want to have 500, 600 points of drawdown? No. So you look at key areas to enter. And of course, with the Japanese yen, is it sees bids on risk-off trading. So when we had the Omicron variant breaking at the end of last year, we saw massive bids into the yen. That just like smashed that outlook for New Zealand dollar yen upside in the short term. We then had geopolitical risk over Russia and Ukraine, and stagflationary risk just weighing on the yen as well. So we had a couple of bids into the yen. Now, medium term, it didn't change the perspective, but it means where do you enter? You enter in a place where you can define, you limit your risk. So whenever you're trading, always think define risk. So here you might think, okay, great, I see the case for more New Zealand dollar yen upside. Where do you put your stop? Well, you can see that this recent swing point here, if we break above there, then that does make sense. If we got below here, there'll be something wrong with the outlook. So, I mean, stops can be very carefully placed, 79.40, just underneath that 79.50 region. And your obvious take profit is just up to this region, probably a little bit higher, 81.80 would do. Okay, so you can see you can define, you know where you're getting out. To the downside, you know where you're getting out. To the upside, you manage your risk. So always trade like that, even if you're really confident from a macro perspective. Exactly the same with like China 50 trade, right? You know, think to yourself, yes, we've got a really strong outlook for this fundamentally now. China's government, China's central bank, they've all come out. We're going to stabilize stock prices. We're going to potentially cut interest rates. We want to help, right? So investors, you know, not stupid. They can see that. That's a fundamental shift. It's support from China. China said, we don't want to see this keep dropping. We're here to help markets. There's also some Chinese tech regulations that might be dropping as well to support the tech sector after, you know, that big conflict there's been between US tech and Chinese tech, and there's been a lot of tension. The US-China trade war from particularly Donald Trump's day, and it hasn't gone away. With obviously China being one of the largest GDP producers in the world, US at number one, China number two now, and China's overtaken Eurozone as a sector, right? So there's a trade war going on there, and tech is one of the key battlegrounds. Okay, but what China's saying is like, we're going to support markets here. You know, don't worry, we're supporting markets. We're stepping in. Right, decent recovery, 10% on the day. Lovely, right? So it means you can define and limit risk, but where do you want to define and limit your risk to? Well, an obvious place would be underneath 12,000. So stops under here, 11.9, and you can look for a move. You know, is that the bottom? Could well be, right? And that means we might look for a move back up to 20,000. So it is possible to look for a move of, you know, 48, 47% to the upside over the medium term. And that for a risk that is what, 13%? So 13% to the downside, 40+% to the upside, 49%-ish, right? So lovely. So that's about 3-to-1 risk-reward ratio. Makes sense. Folks, I hope that helps. Don't forget, I'm back here on Monday looking at the week ahead. I'm here for you guys. Take advantage of the opportunities, ask questions, use the chat box. I'm here. Take care. Have a very good rest of this session, and I hope you trade safely. Watch out for that Fed meeting. It could be a real ripper. Gold could see some real upside, and silver could as well. Look out for it. We've gone through the outlook. Manage risk. Be careful out there, and I hope to see you on Monday. Thanks everyone now. Goodbye.